Are you frustrated by how long it's taking to achieve legitimate financial freedom through real estate? Let's be real. To acquire trophy rental properties that generate enough net positive cash flow for you to actually have bona fide financial independence, whereby the money is paying all your bills and then some, and it's on autopilot because you have management running the properties, and so you have very little, if any, day-to-day activity with those properties. To get there, that doesn't happen overnight. And especially if you're starting off at economic ground zero, like I was, homeless and living out of my truck, the road to real estate freedom can be much longer. The great news is that there actually is a shortcut, and it comes in the form of a little-known IRS tax provision that was slid into the 2017 Tax Cuts and Jobs Act. I am shocked by how many real estate investors have never even heard of this, because it's the biggest shortcut to real estate freedom we've seen in our entire lifetimes. Specifically, Section 179, the changes, the updates, allow up to 100% depreciation for most of the renovations or improvements you could make to a rental property. Now, this is so earth-shattering, this is so groundbreaking, because all of a sudden, an improvement you make to a rental property, which could pay you for a lifetime, you get to deduct it in that calendar year. Now, for more details, I have a link down in the description that takes you to where the IRS describes this in much greater detail. So this is what many of the most successful real estate investors have been taking advantage of, including big companies like Amazon. They've been able to drastically reduce their corporate income taxes while building up their industrial real estate portfolio, because they're building all of these massive distribution centers across America. You've seen that. And they're deducting many of the building costs thanks to Section 179 in these specific updates. But you're not Amazon. So how does this impact? How does this help you? How does this become your shortcut to real estate freedom? For the remainder of this video, I'm going to share with you exactly how you can apply this shortcut. It requires 3 parts to make it work for your personal situation. Before I dive into those 3 components, real briefly, I need to take a digression to share with you something that sets the context. So when you were younger, you were probably told that the best time to start investing and saving your money is as early as you possibly can. And that was primarily due to the subject of compound interest. That the longer the time horizon by which you invest money at a certain interest rate each year, it will have the power of compound interest. And so if you start at age 20, by the time you get to age 70, it's a whole lot bigger than if you started at age 40 and you ended at age 60. And that's true. Compound interest is more powerful the longer the time horizon. But look, our lives are short. We want to enjoy our lives. We want to get things accomplished as efficiently as we can, but we still want to have time for ourselves, our family, and our other pursuits. And so my problem with the argument that you start early so you have this compound interest is you still have to wait 40 years. In fact, before this provision came out, my argument was still the same, that young people have the best chance at saving money and building wealth if they start earlier. My argument came from a different angle. It had to do with our graduated tax structure that we have here in America, whereby the higher your income, the higher your tax percentage. It's the graduated tax trap. So when you're younger, you have less responsibilities. Less responsibilities means you have less expenses. So that even if you have lower income when you're younger, you can actually sock away more savings, or the crown jewel of earning money, and that is after-tax savings. It's a lot easier to pull it off when you have less income because you have a lower tax bracket. But as you get older, you have more responsibilities. More responsibilities mean more expenses. So even though you might be earning more money as you get older, you have higher taxes. And so all of a sudden, you still feel like you are running on a treadmill. You're not making any actual progress. That is, of course, until this update, this 2017 Tax Cut and Jobs Act, where they slid in to Section 179, that's 100% depreciation. So that's my context as we now dive into these three components. This shortcut requires all three components working together. And the first one is to generate high income. And there's two reasons for that. The first reason is because if you're not making much money, there's no need for some magical depreciation provision in the IRS tax code. It doesn't matter to you. I see this sometimes. People are asking me these tax questions, but they don't make any money, so they don't have a tax bill really. So they don't need to save on taxes because they don't have a tax bill, right? So you need to have a lot of income to even have a need for some tax provision. But the second part is this, and I have a great playlist on the acquisition of rental properties that I strongly encourage you to watch as well if you haven't already. And the basic fundamental theme is this. With rental property, you're using money that you have and you're trying to generate a return on investment of that money. Some people ask me, they say, but Phil, what about no money down real estate? Yes, there's so much of that. In fact, I would argue I've been a part of as many or more of those kinds of deals, no money down deals, as anyone alive. And so I know a lot about no money down real estate. And that is a short-term strategy that is used to create income, to create money. So you see where I have notated creative real estate investing and flipping houses as a way to generate high income. I would argue it's the best small business in America. There is nothing that touches it. And over the last 3 years, it's been unbelievably good, and it's continuing to be amazing this year. And what we're seeing from trends is it could be amazing for decades. So this right here is where high income can be earned. Now you may have another profession that you earn high income right now, and if that's the case, great, but you'll still have to be able to fulfill part 2, which I'm about to mention. Either way, generating high income is how you're going to have the fuel in order to acquire this rental property. So part 1 of this 3-part plan is you got to have high income. And I would argue that the best way to get there is with creative real estate investing and flipping houses. If you want to learn a whole lot more about how that works, I have a book I give away for free in these videos, How to Be a Real Estate Investor, that you can get right here. Or also you can learn more about my apprentice program, where I teach people how to be masters of this and how they are making hundreds of thousands, if not more per year, generating a whole lot of income. All right, so that's number 1, generate high income. The second part is that the IRS needs to recognize you as a real estate professional. So I have here 700 plus hours. That's the way the IRS tax code is written. So why does this matter so much? Because what you're going to do with this magical formula here is you are going to earn high income, and then you're going to deduct what we're going to talk about in number 3 is the expenses that you generate from your rental property. They're going to go against your income. This is a really big deal, because if you don't have this, if you're not a real estate professional, all of a sudden, this isn't quite so fancy of a shortcut. Because now all of a sudden, all of the expenses that you generate, all the depreciation you create for your renovations, they can't be used to offset your active income. Instead, it sits there for years into the future to reduce against your passive income from your additional rental activities. And you know what? There's not a ton of income that may come in from that. You'll probably make more money here, and so what ends up happening is you just have this big pent-up pile of expenses, and yeah, it's not the end of the world, it's better than not having it, but you certainly don't get the power of this shortcut. The shortcut comes because you can deduct your high income, your expenses from your rental property in step 3. You can deduct that against your high income or active income. This right here, it's that 1, 2, 3 punch. This is where it all comes together. You've got to be a real estate professional. Some of you are like, look, I don't have 700 hours a year to put into real estate. Well, many of you are already doing that. Many of you spend more than that much time sitting on your phone reading some political blog. You've probably got the time, or you probably should put the time into this. if you really are serious about financial freedom through real estate. And part 3 is so crucial for bringing all this together. So, you're now going to no longer look at rental properties based on the idea of how quickly you can be net positive cash flowing, such as a turnkey property, right? Where it already has the tenant in place, it's already fully renovated, it's already got the management in place, it's perfect, you simply put the down payment down and voila, you've got cash flow. That is not going to help you here. You need distressed, I still put the word trophy, rental properties. Again, I have an entire training on that subject that I strongly suggest you watch on the subject of trophy rental properties. But what we're adding to this equation is the fact that it needs work. There needs to be something added to it. It could be as simple as you turning a regular home into a vacation rental, where all of a sudden you're putting in $20,000 or $30,000 of improvements and furniture, which can all be deducted. But it also could be a property that legitimately needs to be fully rehabbed. Either way, that's where the magic happens, because now the vast majority of your renovations, your improvements, become tax deductions. So you create a huge loss from your acquisition of your rental property, and that loss goes against your high income because you're a real estate professional. Boom, boom, boom. 1, 2, 3. That's the combination. That's how this whole thing becomes a shortcut for you. And look, if you're doing this right, you can do this year after year after year. It drastically accelerates how fast you acquire these rental properties, because now you're not having that problem that I talked about earlier, the graduated tax trap, where you make more money, but now you give more to the IRS, so you still have very little left to go buy rental property with, like turnkey properties. Instead, you get to generate as much darn money as you want to generate, buy as much real estate as you can buy with that generated income, and in most cases, again, not the down payment, but the other parts, you get to deduct, deduct, deduct. It's a marvelous shortcut. All right, y'all. Well, I'm Phil Pustiowski, thefreedommentor.com. As you can tell, I get excited, I get passionate, because this stuff is so much fun. It changes people's lives. If you've got questions and comments, especially on something like this, feel free to put them down below here. I can't give you tax advice. I can't give you legal advice, so you're supposed to talk to your CPA or your accountant on stuff like this. But again, I can give you general ideas. This is for information purposes only. And also, if you want to learn more about how you can work with me directly, consider my apprentice program, where my team and I, we will take you from complete beginner to real estate freedom. There's a reason why my company is called Freedom Mentor. It's because we mentor people to real estate freedom. All right, y'all. Well, again, post any comments, questions you have down below. Thanks so much for watching. I'll see you on the next video.